You are listening to Uranium Spotlight on Tuesday, June 3rd, 2025. Brought to you by PurePoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, PurePoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, the global uranium supply splits east and west. Saskatchewan beats its sales targets, nuclear proves its worth in a grid crisis, and Paladin faces legal headwinds. The uranium spot price ended the week at $70.90 a pound, slipping 20 cents from the previous close. While not a dramatic move, it marks the second week of slight price erosion. The long-term price, however, held firm through May at $80, unchanged from April. That stability continues to signal long-term confidence, even if the short-term market shows some softness. Over the past 2 weeks, spot market activity has been relatively muted. Volumes have tapered off compared to March and April, a pattern we've seen before heading into the summer months when utilities often pause procurement and traders wait for price signals. But even in the absence of strong weekly moves, the spot price continues to reflect a historically elevated floor, still well above last year's average. In the background, long-term contracting remains steady, with utilities showing greater interest in locking in supply for the later part of the decade. That activity helps explain the resilience of the $80 long-term price, which importantly sits at the threshold required to incentivize new production. For equity investors, this kind of price action is a reminder. Spot price volatility is not the full story. The market's long-term fundamentals, rising demand, thin inventories, and a sluggish project pipeline are unchanged. In fact, lower weekly prices can sometimes cool short-term sentiment, offering strategic entry points for investors with a longer view. All in all, uranium pricing remains firm where it matters most, the long-term contract market. If you haven't already, be sure to subscribe to Uranium Spotlight podcast, available on your favorite podcast platform or on PurePoint Uranium's YouTube channel. Events over the past week are reinforcing the view that the uranium market is becoming increasingly divided along east-west lines. Czechia has announced that one of its nuclear reactors will begin using fuel supplied by U.S.-based Westinghouse, replacing the Russian state-owned TVEL, which had been its primary supplier for the last 15 years. This move aligns Czechia more closely with Western nuclear fuel supply chains. In contrast, Russia-aligned EU members like Hungary and Slovakia have continued increasing their purchases of Russian nuclear fuel, even as the European Union works on legislation that would ban Russian uranium and nuclear fuel imports altogether. At the same time, Kazakhstan is advancing plans for a 2.4 gigawatt nuclear power plant, roughly the equivalent of 2 large-scale reactors. Each of those reactors would consume around 441,000 pounds of uranium annually. While Kazakhstan is the world's largest uranium producer and can supply the raw material, it lacks sufficient capacity in conversion, enrichment, and fabrication, services that will likely be critical for getting fuel ready in time for the plant's startup. China is emerging as a strong candidate to build Kazakhstan's reactors. It already has substantial enrichment and fuel fabrication capacity and could potentially scale up to meet Kazakhstan's needs. Russia, another contender, still controls about 40% of global enrichment capacity. However, ongoing sanctions are limiting its accessibility to international markets, giving China a possible edge. Meanwhile, the EU appears firmly committed to weaning itself off Russian nuclear fuel, following the example set by the United States. And while Hungary and Slovakia may resist this shift, they are unlikely to outvote the broader EU consensus, especially with countries like Czechia already making the transition independently as the war in Ukraine drags on. Kazakhstan will likely continue supplying uranium to both Russia and China under existing agreements, but if either of those nations ends up building Kazakhstan's reactors and providing the fuel cycle services, the resulting interdependence will be hard to unwind. All of this points to tightening uranium supply chains for the West. As Europe and North America distance themselves from Russian and China-aligned suppliers, including Kazakhstan, Niger, and to some extent Namibia, they may need to rely more heavily on stable, aligned jurisdictions like Canada and Australia. Given those countries' more limited current production, Western utilities could soon be facing higher prices for secure uranium supply. As the global uranium market continues to tighten, Saskatchewan's uranium producers are delivering standout performance, particularly for investors watching supply dynamics and price trends. Cameco, based in Saskatoon, has exceeded expectations with its 2 operating mines in the province, accounting for roughly 23% of the world's uranium supply last year. That's a significant contribution at a time when reliable supply is increasingly critical. What's more, it's now clear that Saskatchewan's uranium sector outperformed every forecast in 2024, not just in volume, but in price. While the provincial government is originally aimed to reach $2 billion in uranium sales by 2030, that target has already been surpassed. Saskatchewan hit $2.6 billion in uranium sales last year alone, and projections now suggest the province could reach $3 billion in 2025. For investors, this is a clear signal. The combination of tightening global supply and Saskatchewan's proven production capacity is positioning Canadian uranium equities for continued relevance and upside. A recent report from uranium consultancy UxC underscores a growing global reality. Nuclear energy is becoming essential to grid stability. As countries retire coal plants and increase their reliance on low-carbon sources like wind and solar, the challenge isn't just emissions, it's reliability. Traditional energy sources produce power on demand. Wind and solar don't. And that's a problem for grid operators who must keep electricity flowing at a tightly controlled frequency, usually 50 or 60 hertz, with a margin of error of just plus or minus 0.1 hertz. Even small imbalances can trigger blackouts. That's exactly what happened in Spain recently. A surge in wind power, a sharp drop in solar output, and an automatic shutdown at nuclear facilities triggered by overloads combined with an unexpected halt in power imports from France. The result? A destabilized grid and a serious blackout. Contrast that with France. Its grid, largely powered by nuclear energy, the highest share of any country, was far less affected, even though both nations operate on the same interconnected system. The UxC report put it bluntly. Nations are realizing that the clean energy transition cannot come at the expense of reliability. While solar, wind, and batteries are critical tools to boost generating capacity, they're not sufficient on their own to guarantee around-the-clock power. The inclusion of firm, clean baseload generation is essential, and nuclear remains uniquely qualified to fill that role. This has real implications for uranium investors. As more nations recognize that net zero goals require both emissions reduction and 24/7 power reliability, nuclear is no longer optional, it's essential. Yes, wind and solar will remain key due to their cost and speed of deployment. Many projects can come online in just a few years. But nuclear's role as a reliable, carbon-free baseload power source puts it at the heart of any serious long-term energy strategy. For uranium markets, this means demand is tied not just to climate policy, but increasingly to grid security. Australia's Paladin Energy is staring down the barrel of a second class action lawsuit, both tied to its uranium production guidance. The latest potential suit, to be filed in Melbourne's Supreme Court, focuses on disclosures Paladin made between late June 2024 and March 2025. It echoes an earlier action alleging the company misled investors and breached ASX disclosure obligations. At the heart of both cases, downgraded production forecasts from the recently restarted Langer Heinrich mine in Namibia. Paladin initially guided 4 to 4.5 million pounds of U3O8 for fiscal 2025. That was slashed in November to 3 to 3.6 million pounds due to ore inconsistencies and water issues. Then came heavy rainfall, and by March, Paladin withdrew guidance altogether and walked back expectations of hitting nameplate capacity by year-end. The market hasn't taken it lightly. The shares have dropped over 60% in the past year, wiping out billions in market value. But zooming out, Paladin's not backing down, and neither is the broader uranium bull thesis. With long-term prices holding firm at $80 and spot rebounding to $70 in May, investor interest remains strong. Supply constraints driven by years of underinvestment and a highly concentrated production base set the stage for another pricing supercycle. And with uranium mining still banned in parts of Australia, Paladin's global strategy and the spotlight on juniors is only intensifying. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by PurePoint Uranium Group. PurePoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.